We were looking at your tax resident. If you have a bring account in the US and you work you have to pay tax.
Okay, folks. Welcome back. So this week I will send you a to-do list on your project. I know many of you have been putting off working on your project for whatever reason. So this is like a check, so you can go bang, bang as you go too, so you know the sequence of things. So some of you might already be keeping up, so this might just put you halfway down the to-do list. But if you, all you've done is pick your company and that's where you're stuck, there's a lot of stuff to do. And I want to send it out this week because by the time you get to next week, then you're looking at the third quiz and then other stuff starts to come to you. So just to get you kind of initiated and started on the process. So today I want to continue our discussion of the trade-off between debt and equity. Let's see where we were. The biggest single benefit of debt is what? The tax benefit. You take that out, you take out the big reason. You got a secondary benefit, which is you can make some managers more disciplined by forcing them to borrow money. But you can see it's an extreme way of getting somebody's attention. On the other side, we talked about the biggest single worry when you borrow money, which is what if I can't make the contractual payment? The worry about bankruptcy. And we quantified in two numbers. One is the probability that you will get into trouble, which is going to vary across companies depending on how predictable their income is. And the cost of actually being bankrupt or perceived to being in trouble. And I said, the more you worry about that, the less you should borrow, which explains why technology companies often look like they have too little debt. Given their income is, you worry a lot more about the predictability of income and you worry about what the risk that you're in trouble can do to your ranks. Your employees might all leave. Second cost is an agency cost. A fancy word in economics, we use it all the time, but an agency cost occurs anytime you ask somebody else to do something for you. Notice they never do it exactly the way you'd have done it yourself. Why? Because they don't care as much about you as you do about yourself. I'll give you a classic example of agency cost. Anybody in this room have kids? Okay. When you have kids, sooner or later, you need to get away from them because you've been around them all the time. So you know what you do, you hire a babysitter. And this is an elaborate process now. You have to have a 6-week lead to get the babysitter lined up. But it's a classic agency problem because what you want in that 3 hours and what the babysitter wants in the 3 hours are very different things. So as you leave, you tell the babysitter, make sure that the kids get to bed at 8. The kids are small. And make sure they don't get any sugar or ice cream in the last hour because you know what will happen over the course of the night. So you leave at 6 o'clock. You say, I'll be back. We'll be back at 9. At 8 o'clock, of course, the babysitter tries to get the kids up, but kids sense weakness. And they exploit the fact that the babysitter wants to get back to watching whatever she's watching on TV. And they extort. They say, well, with ice cream, maybe it will go up. And the babysitter considers the options. It's told specifically not to feed them ice cream, but then again, it's an hour of fighting with the kids and I want to get back to watching TV, or I can feed them ice cream. They'll be bouncing off the walls, but they're not my kids anyway. She feeds the ice cream, and then at 9 o'clock you come home. The babysitter's in a hurry to leave. You don't know why, but they want to collect their money and leave. And after they leave, you hear the sound of things bouncing off walls upstairs. And of course, you spend a night without sleep. That's an agency problem. You know how you deal with the problem, right? One is you install cameras all over the house. So when you're at dinner, you can watch the babysitter saying, she's feeding them ice cream. We need to deliver the electric shock treatment right away to make sure it doesn't happen. So one is monitoring. The other is you factor in the cost, which is if you go out to dinner, you spend a night without sleep, and that might cost you the next day and the next 2 days. So you either monitor or you build in the cost. Now let's bring this down to debt and equity. So you guys be the bank and you guys be equity investors. Same company, right? What does the bank care about? It cares about getting paid, interest payments and principal payments. What do you care about? You want to make upside. So I come to you with a risky project. It's a good risky project. What are the equity investors? So positive net present value, what do we say? Go out and take the project. If I gave the bank veto power over that same project, you know what they're going to say, right? Even though the net present value is positive, it puts their interest and principal payments at risk. They might say, no, you can't take the project. Your interest and the equity investors' interests vary. I came and borrowed money from you, and when I borrowed money from you, I told you I will never borrow again. And you trusted me. Mistake, because a trusting banker is an oxymoron. Then what do I do after I borrow the money? I go and borrow more money and yet more money because you didn't stop. Already you can see why, if you're a banker, what do? When you lend money, you assume the worst. You write in covenants. You can't do this. You can't do this. Don't even think about doing this. You see where this is going, right? When you borrow money, whether you like it or not, if the banker's worried about you, the cost is borne by you, the borrower, not by the banker, because they're going to put in covenants. Their equivalent of cameras all over is they're going to hire lawyers to watch everything you do. And if they really worry about you, they push up the interest rate in their debt saying, you're probably going to rip me off, so I'm going to charge you 11% rate rather than a 7% rate. That's the agency cost issue. And the more you worry about those constraints, the less you should borrow. Yes? Not necessarily. That might be. In fact, one reason for buying convertible bonds is you get a foot in both debt and equity. And that's why when you're lending to a company where you worry too much, eventually you say, I'm not going to just lend a bank loan with no protection. I want an equity stake. That way, if you try to rip me off, I'll become one of you. But let's think about this agency cost and what kinds of companies the agency cost is going to be greatest at. So you're a banker. So think like a banker. You're lending to 3 different firms. So first is a technology firm. The second is a regulated utility like Con Ed. The third is a real estate corporation. As a banker, in which of these firms do you worry the most about your loan? Because remember, you want to monitor how the loan is used. Which of these 3 companies are you going to worry the most about your loan? Why? It's not just that you're risky. You have no idea where the money is. They claim to be doing R&D, right? But they could be hiring people off the streets, putting white coats on them. So walk around this glass building, act busy. As a banker, you have no idea what technology R&D looks like. Whereas now, do you see why bankers love to lend to real estate? They drive around the building 3 times. It's covered with gold. It must be an even better building. I'll lend you even more money. There's something about real estate that I think just makes bankers swoon. They lend too much, but you can see why. It's physically there. And you know, the nice thing about lending to regulated utilities, remember I said that once I borrow money, I feel the urge to take a lot more risk than I told you I would take. What's the advantage of lending to regulated utility? They can't go out and invest in technology or AI. They're constrained to invest in a business, and that makes your life easier. Now you can see why regulated utilities have among the highest debt ratios out there. Because as a banker, you feel comfortable lending to them because it's physical, and they can't do much with your money that they did not tell you upfront. So bankruptcy costs, agency costs, and there's a third and final cost. And think of this as a minor issue, but it could become more major as business becomes more uncertain. It's nice to preserve some debt capacity for a rainy day, a recession, a great project. The more you value financial flexibility, and I'm going to use those words in a garden sense, which is people use it as a buzzword, flexibility in the sense we need to be able to do things that we can't anticipate right now, but might show up, the less you should borrow right now. Another reason why technology companies choose not to borrow is they feel more uncertain about how the world will evolve. Maybe you'll have to do a big acquisition to stay in this business. AI has become big. You now have to do a $70 billion acquisition. Having that debt capacity might allow you to do things that you need to do in the future. Yes.
What happens during a rainy day when standards are tighter?
But remember, the lending still is based on your earning capacity. So if you have the earnings and the cash flows to cover the lending, even if lending is tighter, you'll be able to borrow the money. So when I talk about debt capacity, I'm assuming you have the earnings capacity to borrow money, but you've chosen not to. Let's face it, Google can borrow a ton of money if they wanted to. Even if their other businesses collapse, their advertising business delivers such a stable and large cash flow, they could carry 10 times as much debt as they do today. They've chosen not to, either because they worry about this uncertainty about the income, or also because they don't know what 3 years from now they'll have to do. Microsoft has a lead on them on the AI in the AI business. Maybe they'll have to do a $10 billion, $100 billion acquisition that they could use the debt for. So if you think about financial flexibility, how much would people care? I mean, I take surveys with a grain of salt because people can say whatever they want. So this is from a survey of CFOs, where they were asked which criterion they put up on top when they thought about borrowing money. What are the things you worry about? Top of the list, maintain financial flexibility. Companies value being able to be flexible, to be able to. Next is long-term survival. Think of that as the bankruptcy cost. Then maintain predictable source of funds, because inertia drives so much of the process. On fourth on the list is maximizing stock price. It's not on top of the list. So when people borrow money, maintaining financial flexibility is right at the top of the list. So let's summarize. Right? You got tax benefits and added discipline on the benefit side. You got bankruptcy cost, agency costs, and loss of future flexibility. So let me make a statement. It's kind of an obvious statement. If the benefits exceed the cost, you should borrow money. So companies which get big tax benefits and need the discipline and have low bankruptcy costs should borrow money. But if the reverse is true, you should choose not to. So I'm going to try this out on my companies. Remember the 5 companies I'm looking at, to think about which ones of these companies should be borrowing the most. So you look at the tax rate. At the time that I did this, the marginal tax rate in the US was close to 40%, 35% federal, 36%, I think, for Disney. Based purely on taxes, Disney gets the biggest tax benefit, followed by Vale with the 34% tax rate. And then you get the lower tax rate. So purely in terms of tax benefits, Disney should be borrowing the most money. In terms of added discipline, remember, Baidu is still run by the founder CEO. You shouldn't need discipline to be picking projects. Disney is a much more separation between shareholders and managers. Even though the CEO might own shares, clearly they get more of their compensation from how much they get paid. So both on the tax benefit and the added discipline side, it looks like Disney should benefit more from borrowing money than Baidu or, I know, Deutsche Bank we got to take out of the picture, but if you look at the other companies. In terms of bankruptcy costs, you worry about 2 things, right? One is the probability of bankruptcy. How volatile is the income? And Disney, because it's diversified across multiple entertainment businesses. It'd be different. It was Lionsgate, right? Entertainment company, but its entire value comes from how will the next movie do? Disney doesn't have to worry about that. Much more predictable income, especially from the theme parks. Again, working in favor of, if you looked at purely in terms of the trade-off, it's going to allow Disney to borrow money. In terms of bankruptcy costs itself, would Disney's rating being lowered from BBB to BB stop you from going to Disneyland? I don't think so. Are you going to not go see the next Avengers movie because it's a lower rated company? I wouldn't. Maybe you would say, I don't watch movies made by BB rated companies. Maybe that's a constraint you put in. But if you think through the costs here, the costs are relatively, I'm not saying they're non-existent, but they're not like aircraft manufacturer costs. So with each company, one of the things you can do is take it through this trade-off. It's purely qualitative. All you can tell me is a sense of direction. This company should be able, no, it doesn't give you a number. We're going to do that next, but it gives you a sense of, hey, this company shouldn't be borrowing money. This company should be borrowing some money. This company should be borrowing a lot of money. So what I'd like you to think about, and this is part of the to-do list on your project, is think about your company in terms of trade-offs. Think in terms of what are the tax benefits. So if you're doing a cruise line company, already you're going to start to hit a roadblock, right? If you're doing a Middle Eastern company, Al-Marai, Saudi food processing company, already you can say, hey, this company shouldn't be borrowing money. The fact that it does, don't let that enter the process yet, because that's a question you're going to ask is, does that make sense? So start with the tax benefits. On the added discipline, what are you going to look at? You're going to look at, is my company run by founders who own a large amount of stock? Is it run by managers who might not care as much? On the other side, when you look at bankruptcy costs, look at the uncertainty of income in the future. Look at the potential bankruptcy costs. And again, subjectively ask yourself, is this the kind of company where I'd worry as a consumer, as an employee, if the rating dropped from BBB to BB? Make that the constraint, from investment grade to below investment grade. There's some businesses where the entire company will break down if that happens. Financial service companies, you can't survive as a BB rated financial service company. Somebody's going to shut you down. So there are constraints that might input. So take that through your process. And again, all it's going to give you a sense of direction, but it's a good starting point for asking, should my company be borrowing money? Any questions on the trade-off? Or maybe there's a cost I've missed or a benefit. Can you think of a benefit for debt that I've missed or a cost that I should add on to this trade-off? Yes.
I have a thought about the cost of bankruptcy, basically, that we speak about. But so when, let's say you know that a company that you owe money to is going to go bankrupt.
So this is a company you owe money to, not yeah.
So okay, let's say you are the one going bankrupt and someone else owes you money, right?
Right.
You would be concerned. Like they would probably not pay you if they know that you're in trouble. Not even if
No. That's not the way it works. Remember that that contractual obligation gets carried over by the bank that takes you over and the courts that take you over. Your contractual obligations don't lapse because the person you owe money to goes bankrupt.
Right. You know how like when companies go bankrupt and it goes over to the courts, usually there's like, they pay 80 cents on the dollar or whatever it is.
No, you're mistaken. They pay 80 cents on the dollars they owe. They don't accept 80 cents on the dollars that are owed to them, right?
Right. Also on that side.
No, not to people who owe money. I've never seen, so the deals are always on people that you owe money to, because it would make no sense for you to accept. If it's a loan, they will go after you, right? That's, in fact, that becomes a first priority, is going after people who owe money to the company and collecting all of it. So the deals usually go the other direction on money you owe other people rather than people owing you money.
So you're assuming you're collecting 100%.
In fact, it actually, because you go from market value to book value, there's actually a step up, because now they're no longer saying 40 cents on the dollar was what the market was paying you. They say, look, you owe us money. We've got the contractual obligation in front. So it actually is worse for those companies in a sense, because now you have somebody on the other side insisting that they get paid, because they're going to use that to cover the claims against the company. So now I'm going to put you in a Twilight Zone episode, one of my favorite shows. So you wake up and this is what the world looks like to you. First, it's a world with no taxes. Sounds appealing already, but stay in this world with me. It's also a world where managers run companies in their stockholders' best interest. They pick good projects and reject bad projects. No company in this world ever goes bankrupt. It's a very strange Twilight Zone episode. I don't think it'll get a whole lot of viewers with these characteristics. Yeah? Equity investors, when they borrow money, don't lie. They tell you exactly what they're going to do. And every company knows its future financing needs with certainty. Now, each of those assumptions I put in deliberately. Think about the trade-off. Let's go item by item. So if you're a company borrowing money, what are the tax benefits you're going to get in this world? Nothing. What about agency costs? Well, managers already do the right thing. You don't need any kind of debt to this, so that goes away. What about expected bankruptcy costs? No company ever goes bankrupt. That's gone. What about agency costs? If people don't lie to each other, there is no agency cost, right? Equity investors say, I'm going to do R&D, and they actually do R&D. As a banker, you don't care. There's no agency cost. And if you know your future financing needs with certainty, you don't need flexibility. So in this world, how much should you borrow? You have no benefits and you have no cost. So if you borrow nothing, there's no benefits, no cost. If you borrow $10, there's no benefits, no cost. If you borrow $100 million, there's no benefits, no cost. It doesn't matter how much you borrow. Congratulations, you've derived corporate finance's most famous theorem. It's called the Miller Modigliani theorem. In a world with no taxes, no agency costs, and no default risk, it does not matter how much you borrow. I told you corporate finance, started this class, was 64 years old, traced back to a paper in 1958 by Merton, Miller, and Franco Modigliani. That was the paper. You're saying, that makes no sense. But in the world they described, it makes complete sense, right? No taxes, no default risk, no agency costs. Doesn't matter how much you borrow. And the other implication is your cost of capital will be the same no matter what debt ratio you have, because whatever you gain by borrowing money, you'll exactly offset in the change. So your cost of capital at 10% debt, 20% debt, 30% debt will stay a constant. You think they gave a Nobel Prize for somebody who said, doesn't matter how much you borrow. Merton, Miller, and Franco Modigliani set up the framework for the trade-off. They were the ones who brought in the bankruptcy costs and the tax benefits. And you can change one assumption. You can very quickly see how that. So in a world where I introduce just taxes, let's say I introduce just taxes in this world. You're still in a world with no bankruptcy costs, no agency costs. How much should you borrow? 100%. If I introduce a world where there's no tax benefits and introduce bankruptcy costs, which is the middle, I borrow nothing. It's an amazingly powerful framework. But the tragedy of the Miller Modigliani theorem is there are generations of people who've gone through corporate finance classes. And you ask them, what's the only thing you remember about the capital structure lecture? They'll say it's a Miller Modigliani theorem. And how convenient. It doesn't matter how much you borrow, so it doesn't matter if I don't remember any of the other stuff. I've heard corporate finance bankers use the Miller Modigliani theorem. Every time you start to talk about debt, they say, do you remember the Miller? It's like garlic with a vampire. Miller Modigliani theorem, Miller Modigliani theorem. Back off, let's talk about debt. And to show you the irony of talking about the Miller Modigliani theorem, I remember very early in my teaching life, 87 or 88, it was the height of the LBO boom. Somebody graduated from this class, went and joined an LBO outfit, which was actually involved in the federated LBO, one of the most misplayed LBOs of all time. The LBO blew up, took his firm down, he went bankrupt, he lost his job. But 5 years later, he's somewhere else. I ran into him on Wall Street. And I asked him, what do you do now? And he says, I work here. I used to work for this LBO firm that did the Bloomingdale's LBO. And I said, that never made any sense to me. Why would you borrow money and buy a department store, an high-end department store whose earnings and revenues are going to go up and down? And he said, don't you remember the Miller Modigliani theorem? I said, I do. And I'm glad you live in a world with no taxes, no default risk, and no agency costs. But remind me again what happened to the place you used to work at? Without a trace of irony, he said it went bankrupt. He's talking about the Miller Modigliani theorem and a firm going bankrupt in the same 2-minute span. And he couldn't even see the contradiction because the Miller Modigliani theorem assumes what? Nobody goes bankrupt. In a world, so let's get this clearly on the table, because I don't want anybody to walk out of this room and use the Miller Modigliani theorem, the world that you and I live in, which as April 15th approaches is definitely not a world without taxes. And where you've had SVB happen a few weeks ago is definitely not a world without default risk. So can a company borrow too much? Of course it can. We're not in a Miller Modigliani world. Can a company borrow too little? Yes, it can. Which means that we're setting the process up for asking, hey, when does it even make sense to use the Miller Modigliani theorem? I think it makes sense to think of it as a limiting case. So the closer you get to the Miller Modigliani theorem, the less you worry about debt. So if you're in a country where the government guarantees you that you cannot default, they back you up, and you have no taxes. Remember, in Saudi Arabia, for the longest time, the Middle East overall, when companies got into trouble, governments were flush enough with cash that they would step in and bail the company out. You could argue, in a world with no taxes, the government bails you out if you borrow money. Maybe that explains why Middle Eastern companies borrow money, because they actually live closer to a Miller Modigliani world because of the structure of those companies. So don't dismiss it entirely, but use it as a way of thinking about debt because it is a useful structure. Now, before we actually look at coming up with an actual mix of debt and equity that reflects how much you can borrow, I want to talk about what managers think about when they borrow money. So we're not talking about shareholders, we're thinking about what managers think about. There are two things that managers value. One is I talked about flexibility. They like to be able to borrow money or raise capital and do whatever they want with it without people asking them questions about how is the money being used. As a manager, it's nice to have that. The second is they value control. They like to be able to do what they want with the capital. You're saying, so what? I'm going to give you the results of surveys that have asked company CFOs, in terms of financing, to rank choices from their most preferred way of funding projects to the least preferred way. So I think you can, collectively come to a judgment. If you're a company and you had a choice of raising capital for a project, what is the choice that gives you maximum flexibility and control? Retain earnings. Why? Because you don't answer to anybody, right? It's income you already have. Your shareholder at a meeting might say, why do you pay me so little in dividends? Retain earnings, you basically have complete control over. There's no covenants to sign, no agreements to make. And guess what? If you look at the most preferred choice, so this is from CFO surveys, retain earnings is number one. You know what the next best choice is? Just conventional debt. No special features, no convertibles. Then comes convertible debt. Then comes common stock. This is equity issuances. Think in terms of, and if you think about why, it's really flexibility and control driving. So you've got retained earnings, straight debt, convertible debt, common stock. And then you get to the bottom of the barrel. And you do this only because you get desperate. You go preferred stock. If you're truly, truly desperate, you go convertible preferred stock. There's a hierarchy of financing. And here's the way it plays out. Now, when you finish this class, go check out the Wall Street Journal because companies announce they're going to raise capital. They tell you how. By looking at how companies raise capital, you can get a very quick sense of, is this company in trouble or is it healthy? So a company issues, so you open up the Wall Street Journal, it says company issues convertible preferred. Does it tell you about the company? Yeah. And in fact, I think it's Bed Bath & Beyond. Just a couple of months ago, guess what they used to try to raise money? Didn't even work with convertible preferred. Tells you how much trouble they're in. But they offered convertible preferred. Why do you have to offer a conversion feature? Who wants to lend money to Bed Bath & Beyond without strings attached? How many covenants would you have to write? The only hope you have is maybe something good will happen. It's an option here. The conversion option does. So when you look at companies, you can very quickly see what they prefer by looking at what they actually use. So it shows up in a couple of ways. One is from the graph I showed you earlier, but now this is with US companies. We look at where companies raise money. By far, the biggest chunk of money comes from what I call internal financing, that's retained earnings, followed by straight debt. But once companies go public, it's very uncommon, very unusual to see them issue new shares. When did Microsoft go public? Anybody know? 1986. You know how many times they've issued shares since they went public? 0. That tells you something about how companies grow. And if you think about how much Microsoft has grown over the time, and the bulk of the time it had no debt, it shows you how, if you're a successful company, retained earnings can essentially power your company's growth over the lifetime of a company. And as I said, looking at a tombstone ad and seeing what companies are using to raise capital can very quickly start to give you an indication, at least. It's not perfect, but it's an indication of it, at least, of, is this company healthy? Is it in trouble? So companies that are healthy tend to issue straight debt. That's basically what you'll see. If you see convertible debt, already they're telling you they're not as strong as the company that issued straight debt. If you see common stock, then clearly there are enough trouble that they can't even use debt. And then you get to the preferred and the convertible preferred. Then you're really, really in trouble because you're going to the bottom of the barrel. So that's the financing hierarchy, again, something that companies seem to do. Is it the same across the world? For the most part, I've seen these financing hierarchies in Europe as well. The only difference in Europe, sometimes because they make rights issues more frequent, we talked about rights issues where you can raise equity by issuing shares at below the market price, very low issuance cost, you're able to raise the money much more easily. Because the rights issues, European companies are slightly more likely to issue new equity because they use the rights issues. US companies hate rights issues. They think of it as dilution, which is stupid because everybody gets a share anyway. So, but because of that, I think European companies are a little more inclined. But other than that, you get the same commonalities. Yes?
We analyze facts. How do you catalog it?
In fact, with banks, what's going to be the big driver of what you issue? Regulatory capital. You look at the definitions of regulatory capital, they're going to thread the needle because whatever you're going to be able to get classified as regulatory capital, you're going to be much more willing to issue. So if you look at Credit Suisse, they actually had a special issue of debt. And I don't know who bought this debt, but this debt actually gave them no claims. It's like debt without contractual claims. He's saying, who'd be stupid enough to do it? Somebody was. And guess what happened on the, when Credit Suisse, got bought out? That debt actually got wiped out ahead of equity. I feel no sympathy for people who do that because you get greedy and stupid at the same time, then maybe this is exactly what should happen to you, right? So when you look at banks and what they use, they do these strange contraptions. What the heck is that? It's because and I think it's a mistake. I think banks, for the most part, should just issue straight equity. But trying to thread the needle and issue these very strange, convoluted securities, they end up with these messes on their hands. So there again, the more troubled a bank is, the more convoluted these securities will start to get, because that's the only way you can get them through. Yeah. So now let's focus in on finding the financing. So far, we've talked about the trade-off, but the trade-off that I've talked about so far just tells you should a company borrow more or less, but it doesn't tell you whether they should borrow 40% to 30% or 60%. So I'm going to give you a bunch of different ways of thinking about optimizing your financing mix, but I'm going to spend the bulk of my time on the first approach because it's an extension of what we've already done. Up till now, we've talked about the cost of capital as a hurdle rate, right? I'm going to give you a different way in which cost of capital gets used because that's going to be an opening for me to use the cost of capital to find the right mix of debt and equity for your company. I'm going to start with the standard cost of capital approach, and then I'm going to admit some of the weaknesses in that approach, things we're ignoring. So I'm going to create a second approach, which builds on the cost of capital, but takes care of those weaknesses, especially in terms of bankruptcy costs. There's an approach that the University of Chicago developed called the adjusted present value approach, which is used, I think, misused in a lot of banks. I'm going to talk about how to do it right, how you will see it used in practice, and the kinds of questions you need to ask to get it done right. And then I'm going to talk about the way most companies borrow money, which is they look at everybody else in the sector and say, if everybody else is borrowing money, it must be right. It's a Me Too approach to that. Very dangerous approach. No. And I'm going to talk about doing that. And remember the life cycle approach, which is you ask yourself, it's actually a very effective way of deciding how much to borrow. Am I a young company? Am I a mature company? So let's start with the cost of capital approach. I mean, cost of capital so far in this class, we've used as a hurdle rate. But if you think about cost of capital in the context of valuing a company, it becomes the discount rate used to value an entire company. So you can actually value a company as the present value of the cash flows, the entire company, discounted back at the cost of capital. So let's play a game. Let's assume and those cash flows are pre-debt cash flows. So let's assume I can keep those cash flows fixed and lower my discount rate. Humor me, what happens to my value? It goes up, right? As my discount rate goes down, my value goes up. What's the objective in corporate finance? Maximize the value of the business. If I take that objective to its logical limit, you know what my cost of capital, what my objective of the cost of capital is, right? I want to minimize my cost of capital. Reframing cost of capital. Now, what's the cost of capital determined by? Cost of equity and cost of debt weighted by the proportions of debt and equity. Put simply, if I can find a mix of debt and equity that minimizes your cost of capital, which might not be a current mix, that is your optimal debt mix. Very simplistic, but a very effective and intuitive way of thinking about what's the right mix for you. Now, here's the problem, though. I've seen people do this by leaving the cost of equity and cost of debt fixed and just changing the ratios. If you do that, you're going to end up with 99.99% debt. Why? Because the cost of equity is always higher than the cost of debt. It's a dynamic process. And here's what I mean by dynamic. As you borrow money, both the cost of equity and the cost of debt go into motion. Let's start with the cost of equity. You're an equity investor in a company. Don't think beta, levered beta. Let's keep that to the side. Think like an equity investor in a company. You start with 100% equity. And you say, okay, I feel pretty comfortable. You come up with a cost of equity. The same company now goes out and decides to borrow money and fund half its operations. You're still the equity investor. Same business. Are you exposed to more risk? Yes, because you have those interest payments you got to make. Your equity earnings will become more volatile the more you borrow. It's just intuitive. Your cost of equity should go up. That is the underlying logic for why we compute levered betas. The levered beta is not some contraption we use to throw in an equation. It's to capture the fact that the same business becomes riskier to its equity investors as you borrow more money. So the cost of equity goes up. So that's the cost of equity. What about the cost of debt? You're a 100% equity company. You come to borrow money from you. I charge an interest rate, but I see a very safe company. So the first 10%, I might say, you look very safe. I'll lend you money at 5%. You're now at 10% debt. You come back and try to borrow money again to get from 10 to 20%. As a bank, I should charge you a higher cost of debt. Why? Because you now bear more risk than you did. So your cost of debt also needs to go up as you borrow more money. And there the mechanism gets more creaky, right? Because when I look at a company, I have a bond rating for the company given its current debt ratio. But if it borrows more money, I can't go to S&P and ask, what rating will you give them if you, I can ask them, but they're going to say, I can't tell you the answer. So you have to estimate what their rating and cost of debt will be if they go to, you know, the cost of debt will go up, but you don't know how much. And here's the opening we're going to use. Remember that interest coverage ratio that we used to get a synthetic rating for your company, but didn't have one now? I can use that process at least to estimate what your rating will be at hypothetical debt ratios. Even if you have a rating right now, I can use the synthetic ratings process to get it. So here's the mechanism we're going to use. As the debt ratio changes, I'm going to adjust the beta to be a levered beta. My cost of equity will go up. As your debt ratio changes, I'm also going to recompute the interest expense. So if you double your debt, your interest expense are going to go up. I'm going to use the higher interest expense to come up with an interest coverage ratio, which will be much lower at a higher debt ratio, and use the synthetic rating table and say, this is what your rating will be at 10, 20, 30% debt. So let's put something to the side. And this is something that I think we've talked about, but I want to nail down. Which is, this is built on the premise that you're looking at cost of equity through the eyes of the shareholders of your company, which I think makes sense. But I talked a little bit about this, when we talked about cost of equity, how there are some companies that believe that equity is cheaper than debt. Why? Because just the dividend yield. Remind me again why that's wrong. because there's expected price appreciation that equity investors want. And you're saying, so what if I don't deliver it? I can't be held back. You're right. You can't go bankrupt. The only thing they can do is push down your stock price. You might say, I don't care about that either because I don't plan to issue shares. And then you hit them with, you might lose your job because they turn against you. And you might say, I don't care about that either because I'm a family member and this is a family controlled company. This is tied to corporate governance. The more you worry about your shareholders and what they can do to you, the more inclined you will be to buy into this way of thinking about an optimal debt ratio. So when you try to sell this to an Asian family-run company and they say, no, this doesn't work for us, recognize where it's coming from. It's not coming from them not understanding the mechanics of what you're trying to do. They just, at a core level, they disagree with what a cost of equity and a cost of debt are. And those companies, God only knows what kind of mix you'll end up with debt and equity because you're not delivering a cost of equity based on any outsider's view of what your cost of equity is. In fact, I've asked a question. This is actually an interview question that you might get asked at some point. I said, debt should always be cheaper than equity because the lender is ahead of the equity investment line. There is one exception to this rule. And I'll tell you what the exception is. It's a publicly traded company in a business which actually doesn't move with the market at all. Gold mining companies, right? Remember we talked about the betas? They could be, forget about the negative beta. Let's say the beta is close to zero. Why? Because this business has nothing to do with the rest of the market. What's going to happen to your cost of equity? If your beta is close to zero, it'd be risk-free rate, right? And you can never borrow at the risk-free rate. For those companies who think there's the exception, the cost of debt can be higher, it can. But if you take this to the logical next step, gold mining companies should be entirely funded with equity if they're publicly traded companies. Because why borrow money when equity investors are willing to invest in your company at this incredibly low cost of equity? So can equity ever be cheaper than debt? That's the only exception I can think of. In most other companies, or 99% of companies, you can make the argument of, I have the last claim on the cash flows, and therefore I'm going to charge a higher rate than the person in front of me. So let me show you a table I was shown in 1979. So my first corporate finance class. Professor walks in and he says, today we're going to talk about the optimal debt ratio for XYZ widget company. I've never understood this fixation with widgets. Have any of you guys seen a widget? I don't even know what it's used for. But in business school classes, they talk, you know what the nice thing about talking about a widget company is? You can make up whatever you want. Nobody's ever seen a widget and say, I've never used a widget like that. Talk about discretionary, non-discretionary. Already the antenna is quivering. XYZ widget company is going to show up some abstraction. He said, it's very simple. He put up the table and he said, as your debt ratio goes up, your cost of equity will go up. And he gave the story. The story made sense. And then this person in the front row, wasn't me, put up his hand and said, but why is it going up the way it is? Because if you look at the numbers, it looks like it goes up 0.5, then 0.6, then 0.7. Basically, it looks like he made up the numbers. He says, don't worry about the numbers. It's the logic that counts. I said, okay, let it right. Then he said, as you borrow money, your cost of debt will go up. Again, he gave a story. And again, the same person in the front row. He was a designated questioner, put up his hand, said, why is it going up the way it is? And he said, well, don't ask questions about the numbers. It's the logic that matters. And then he took a weighted average, and then basically it's, take the proportion of debt and equity, and he said, there's my cost of capital. And he said, the point at which the cost of capital is minimized, which is 40%, is the optimal debt ratio. He didn't understand why we were so dissatisfied. He thought we were just dim-witted. He said, if you don't get it this way, let me show it to you in a different way. Can you get it now? This is a low point on the cost of capital graph. He completely missed the point. We understood what he was doing. The question we were asking then was, why is the cost of equity changing the way it is? Why is the cost? Because if we were given this entire table for a company, would any of you have trouble finding? I mean, I have a 5-year-old grandson. I could probably train him with enough candy bribes to find the lowest number. He has trouble with decimals, so he might have to know. But if all you had to do is look down the lowest point, this would be a no-brainer, right? The real challenge, and I remember walking out of that class saying, I want to do this on a real company. I didn't have the tools completely to do it, but that was what I spent that weekend on, is if I took a real company, how many numbers on this table would I have? How many numbers for a real company? Given where we are in the class, assuming you've been keeping up, let's assume at the moment, how many points in this graph would you have for your company? 1, which is the existing debt ratio. There is no table, there's a point. I don't have a graph, I have a point. So you can already see what you need to do to use this is actually go from the point to the rest of the table. That's basically why I set up the structure that I did, is I need a cost of equity and a cost of debt. But here's the problem. If you get a beta from a regression, and that's the only way you use betas, you're kind of stuck, right? If I ask you, what's the cost of equity? You can say, give me the number. And say, what will happen to this number if I double my debt? You say, I have no idea. I have to run a regression after you've done it, maybe 3 years after, but that'll be too late. If the way you get cost of debt is you do what many people do, take interest expenses and divide by the book value of debt, it's kind of static, right? It's not going to change overnight. So here's what I'm going to do. I'm going to start by nailing the 1 point down before I get ambitious. For Disney, I have the 1 point already. The beta that I got, remember that bottom up beta 1.0001? That beta gave me a cost of equity of 8.52%. So that's the bottom up beta done in US dollars, because I'm going to stick with dollars for my entire cost of capital graph, using the equity risk premium that's a weighted average. So that's the cost. The cost of debt we got by looking at the actual rating for Disney. And if you have an actual rating, don't go looking for trouble and doing a synthetic rating. That single A rating gave me a default spread of 1. So basically the 3.75% is the risk-free rate of 2.75% plus the default spread. And the 1 minus tax rate gives me an after-tax cost of debt. The weights are market value weight. So this is the existing cost of capital for Disney at about 89% equity, 11% debt. So let's frame what we're going to try to do. We're going to try to change the debt ratio. And what are we trying to find out? Will the cost of capital for Disney be lower or higher if I move away from my existing debt ratio? At first sight, you're saying it's obvious. It's going to get lower because the cost of equity is higher than the cost of debt. But be careful with that logic, because that logic will always drive you to more debt. So I've got to do this right. So let me start with the equity part, because I think doing the levered beta is the easier half of this equation, because we have a mechanical equation. I can tell you what the beta will be. So I'm going to start with the equity, come up with a levered beta at every debt ratio, give you a cost of equity. For the cost of debt, I'm going to first compute the dollar debt you will have at every debt ratio. So if I go from 10% debt to 20% debt, I'm going to double my debt. I'm going to take the dollar debt and compute an interest expense. Use the interest expense to come up with a coverage ratio, and use the coverage ratio to come up with the rating. Already there's a circularity there, which, I don't know whether you see it yet. But to get from debt to interest expense, what do I need? I need an interest rate. To get an interest rate, what do I need? I need the interest expense. So I'll talk about how I try to get around that circularity. But if I can get around that, I can come up with a rating at every debt ratio and a cost of debt at every debt ratio. I've got to stop and make sure I get the full tax benefit. What do I mean by that? As I get to higher and higher debt ratios, my interest expenses go up. And if they go up above my taxable income, above my operating income, I run out of tax benefits. So I'm going to make sure I get that. And I'm going to end up with a table that just looks just like the XYZ widget company's table. But it's a table where if you point to a number and say, why is my cost of debt for Disney 5.3% at 60% debt? I should be able to take you through the process. It's because if this much in interest expense, this is the rating I gave them. And you can disagree with the process, but at least there's a process. So let's start with again, with the numbers we know. To do all of this, I need an unlevered beta. And now you saw why we spent so much time levering and unlevering betas. It's not because we like the process, but because we need that as an input to this part of the process. I could, of course, cheat and go with the regression beta. Remember, you can unlever a regression beta, but that takes all of the mistakes in your regression beta and keeps them intact. The alternative I suggested was to break Disney down into its businesses and take a weighted average of the betas. So this is actually exactly the table you saw 10 sessions ago. My unlevered beta for Disney is 0.9239. That's going to be the driver for every single levered beta. The other background information I needed was to see how much they have as operating income. Do you see why I need this? To get an interest coverage ratio, think of what goes in the numerator, their operating income. Again, I looked at their existing financials, and if you look at their existing financials, their operating income adjusted for leases is 10.03 billion. That's a number that I'm going to think about when I think about borrowing money is, am I borrowing too much or too little? It's going to be relative to the 10.03 billion. Now, if you're saying, what if my last year was a really good year, a really bad year? Use common sense, right? Because you want to borrow not based on just last year's numbers, but what you can do over time. So if you want to take an average across the last 5 years, some kind of normalized number, by all means do so. It actually makes more sense. Here, I'm going to stay with the most recent year because there's no reason for me to think it was an unusual year. You ready? Here's what we're going to start with. We're going to start with the cost of equity. As my debt ratio goes up, so at 0% debt, my beta is my unlevered beta. At every debt ratio, 10%, 20%, 30%, as my debt to equity ratio goes up, my levered beta goes from 0.92 to 6.24. So at a 90% debt ratio, 90% debt, 10% equity, my beta looks like it's out of the world, and it should. And as my levered beta goes up, my cost of equity goes up. I've got half the table done. I now have a cost of equity at every debt ratio from 0 to 90%. So this is an extension of what we did in the first third of the class, kind of applied to, hey, what will happen if the debt ratio changes? Any questions on the cost of equity changing as my debt ratio changes? Let's talk about the cost of debt. And I'm going to take you through the mechanics. This is going to be a little tedious, but hang in there, of how I would do this by hand. You're saying as opposed to what? I'm going to give you an Excel spreadsheet that does the whole thing for you, but I don't want it to become a black box because I started by doing this on a ledger sheet with a pencil and a calculator. So you can actually do this with a calculator and a pencil. So I said, okay, I want to see what Disney's cost of debt will be at 10% debt. So here's what I did. I started with 0% debt. Of course, I gave them a AAA rating because at 0% debt, you might as well give them a AAA rating because nobody really cares. You're not borrowing money. You go to 10% debt. Here's the first step. I computed how much debt will they need to get to 10% debt. And to get that, I took the market value of equity and debt that Disney had, the enterprise value for the firm, which is 137.8 billion. I said 10% of that is 13,784 million. So that's my first stop, is I've now figured out how much they will need to borrow to get to 10% debt. My EBITDA was 12.5 billion before they borrowed money. It stays 12.5 billion after they borrowed money. That's very weird. I'm borrowing all this money, but it's having no effect on my EBITDA or operating income. So what has to be happening to the money coming in to keep my business kind of intact? It can't be invested in new projects, right? Because it'll affect EBITDA. Whenever you look at optimal capital structure, you're doing what's called a recapitalization. Basically, what you're doing is you're keeping your assets the same. Now, borrow money, it's either being used to pay a special dividend, reducing equity, or buying back stock. Why do we do that? Because we want to isolate the effect of changing the financing. Because the minute I bring in projects, I have two effects, right? I have the effect of my debt and the projects. So to keep this effect clean, I'm taking no projects. So my EBITDA is going to stay unchanged. My EBIT is going to stay unchanged. And for the moment, kind of hang in there. I need an interest coverage ratio, so I need an interest expense. So I take the dollar debt and I multiply it by the cost of debt I had when I with a AAA rating at 0% debt. Already you're saying, but that's going to be unrealistic. I agree, but I'm going to start there. That interest expense I get is 434 million. 10,032 divided by 434 million gives me an interest coverage ratio of 23.1. Remember that lookup table that I showed you at this, when we talked about cost of debt? I went to the lookup table and I heaved a sigh of relief. And here's what. What's the rating I'm going to give Disney at 20, with an interest coverage ratio of 23? Well, that's above. So I'm going to give them a AAA rating. And you can see why I heaved a sigh of relief, because the rating I'm giving them happens to be the rating I used to get the cost of debt. I got lucky. But I'm done. My cost of debt is 3.15%. That's my cost of debt at 10%. This was the easy first step. To get from 10 to 20% or 20 to 30%, let's see if you can help me out here. So there's the 20% debt ratio. I've computed it. Their cost of debt is still 3.15%. Let's say they go to 30% debt. To get from 20% to 30% debt, the dollar debt has to go from 27,568 million. So every time I add another 10%, I'm adding 13,784 million in debt. So my debt goes. My EBITDA, depreciation, EBIT stay the same. First step, I multiply the 41,352 by 3.15% because that's the only thing I know. I know that the cost of debt, the previous debt ratio, I come up with an interest expense of 1,302. Divide the 10,032 by 1,302, I come up with an interest coverage ratio of 7.7. And I have a problem. Do you see what my problem is? At an interest coverage ratio of 7.7, the rating I'm giving them is AA. And the cost of debt I have is actually 3.45%, not the 3.15% that I use. So when I was working through this by pencil, I said, yeah. I used stronger language, but no, it wasn't making me happy, but it wasn't a big deal, right? Because the only thing that I was getting wrong was the interest rate. So I redid the interest expense with a 3.45% interest rate, which pushes up the interest expense, and said, please God, because you know what could happen, right? With a higher interest expense, I could slide again. But here it looked like with 1427, my interest coverage ratio leaves me at a AA rating. So how many iterations do I have to do? 2. The Excel spreadsheet that you're going to get. If you ever used Excel preferences as an iteration box, you can check the iteration box, and Excel will actually take numbers which are circular and run them through. I think the default is 100. I set it to 1,000, which is overkill because I needed only 2. I've never had to do more than 3 by hand, but it seems to take Excel no time. So what Excel does is it does this at every debt ratio. It spins back and forth. It converges and says, this is your cost of debt based on that. It does make the spreadsheet a little moody. So it's sometimes, depending on the direction you come from, your rating can shift a little bit in one direction or the other. But I want to make sure everybody gets a process. Question?
So when we add the
right.
We are assuming the value of the original debt stays the same.
We are assuming that the market value of the debt gets repriced because the interest rate on all of your debt. So basically, here's what I'm doing. When I borrow the money, remember, if my interest rate goes up, I'm actually setting that same interest rate. It's almost like I'm refinancing the existing debt at the 3.45% rate. So that's why I'm not giving you the advantage, because you're going to say, but I borrowed the first 10% at 3.15%. Now, why are you charging me 3.45% on all my debt? It's because the only way I can keep the market value intact is by assuming you refinance all of your existing debt at the new interest rate, which I think is actually the right thing to do, because eventually that debt will have to get refinanced. Yeah. So I'm doing it to kind of make sure that I'm not borrowing money because I have cheap debt right now, and then finding that debt comes due in 6 months and saying, oh my God, I shouldn't have done this. So my interest expense is actually computed acting as if I pay the full new interest rate on all of my debt. Yes.
Can you go back to that table, the other?
No. This table? This one.
No, the one you're getting. So the pre-tax cost of debt,
right?
You're getting, it needs to be company specific, right? So are you taking the spread basically and adding?
It's not, it's rating specific. So a company's cost of debt is going to be a function of whatever it's rating. So I'm just asking
the spread, right? That's rating, and
the spread is not company specific, right? It's rating specific. It comes from looking at all bonds out there with that rating. So when you see my default spreads in that table, it has nothing to do with the company. It's got to do with, if your bond has this rating, this is the default spread you will be paying today.
So how do you get to the 3.45? How do you get that?
Well, because your risk-free rate is 2.75%, right? At a AA rating, my default spread is 0.7%. 2.75 plus 0.7% is 3.45. So all you're doing is adding the default spread onto your risk-free rate. And those default spreads, come from looking at bonds out there today. So let me repeat the process again. At each debt ratio, first step, I compute the dollar debt. Second stop, I compute the interest expense, knowing fully well it's unrealistic based on the previous level's interest rate. Third step, I compute an interest coverage ratio based on that interest expense. Fourth step, I go to the ratings table, come up with the rating and a new interest rate. And if it happens to be the same as the interest rate I use, which is what I got, I stop. But if it's not, I recompute the interest expense, recompute the interest coverage ratio, recompute the rating, and hope it hasn't changed. If it hasn't changed, then I'll do a third iteration until it converges. And I do this at every debt ratio. So I'll show you what the bottom line looks like. There's my dollar debt as I go from 0 to 90% debt. At each step, I'm adding $13,748 million in debt to get to the next level. As my dollar debt goes up, my interest expense goes up more than proportionately. Why is that? Because my cost of debt is going up, right? So it's not going to, so the initial debt, the 10%, I use 3.15%, 3.45%. No, so my interest expense goes up more than proportionately. As my interest expense goes up, my coverage ratio goes down, obviously, because my EBIT stays the same. As my coverage ratio goes down, my rating, which starts at AAA, starts to slide. And as I get to higher and higher debt ratios, it slides even more. As my rating slides, my default spread widens and my cost of debt goes up. And to get my after-tax cost of debt, I multiply by tax rate. But then something strange seems to happen in the tax rate. And I kind of gave you a clue on why. Once I get to about 70%, my tax rate goes down. And that's not a good thing in the context of cost of debt. What do I do when I compute a cost of debt and multiply by 1 minus the tax rate? I allow for the tax benefit from debt, right? But how does the tax benefit work? The IRS doesn't mail you 36% of your interest expense as a benefit. It comes from having enough income to claim the tax benefit. You know what's happening when I get to 70% debt? That interest expense, remember my operating income was 10,032 million. My interest expense is now exceeding my operating income. And I'm saying, look, you can't get the entire tax benefit. You can get it only up to 10,032 million. So if you want to know how I'm computing this tax rate, and I don't even know what to call that tax rate, it's like a marginal tax rate with the tax benefits lost. Here's what I do. I compute the maximum tax benefit you can get, because at 10,032, you capped out. So you get the 36.1%. I divide the tax benefit by the total interest expense. And my tax rate is, so when I get to 70% debt, that tax rate becomes 32.64%. When I go to 80% debt, it gets even worse, because now within higher interest expense, I'm still capped at 10,032. So my after-tax cost of debt starts to rise because I'm starting to lose tax benefits. You think, but I can't, can I carry them forward? Normally, I would say yes, but this isn't a temporary problem, right? You went to a 90% debt ratio, did a leverage buyout. You've created a permanent problem for yourself, and I've got to factor that into your cost of capital, saying this isn't going away because you have a good year, because you just borrowed way too much. So my cost of debt here reflects, and I can now bring them together. My cost of equity reflects my levered beta. My cost of debt comes from my synthetic ratings and my tax rate. There's my cost of capital. So this is my Disney analog to the XYZ widget company, but every number on the table, if you point it and say, why is that number what it is? I'm not going to say it's the logic. I'm going to actually take you through the process. This is the levered beta. This is the cost of equity. This is what the rating looks like, and this is what's happening to my tax rate. And what's the optimal debt ratio for Disney? 40%. It's unfortunate we've had 2 examples in a row with 40%. Remember, I was doing this for, I think it was a bankers trust group before they went bankrupt, and maybe this is the reason they went bankrupt. And this was for a bunch of seasoned bankers who'd be brought back for a re-education camp. And there was one guy that obviously did not want to be there, and he made it very clear he did not. He sat in the back row, put his feet up on the chair in front of him, and read the Wall Street Journal, except he never turned to another page for like 2 hours. As we go through this, and as he get to this, he puts up his hand. He says, finally, he's going to ask me a question. He says, can we safely assume that the optimal debt ratio for all companies is 40%? The answer to that is absolutely not. And you know how we're going to find out? You're going to do this optimal debt ratio for your companies, and I'm going to put up a graph of what you find as the optimal debt ratio for your companies. And guess what? It's not the same percentage. So some companies, the optimal debt ratio would be 0%. Even getting to 10% is way too much for them because the ratings blow up. For some companies, it could be as high as 70%. So we'll talk about what drives the optimal. But you can already see that the optimal is going to be driven by the kinds of inputs you put in, the unlevered beta, the operating income. It's a large company or a small company, all of those things will play out in the optimal. Now, when I took my corporate finance classes, every example in the capital structure had this nice U-shaped cost of capital based on XYZ widget company. And so when I started doing this for companies and I drew this, first thing you notice, it's not a U shape, right? And this is something to remember when you think about borrowing money. As you borrow money, your cost of capital goes down, but it doesn't go down that much. Don't expect miracles in terms of cost of capital going from 9 to 6%. Changing your debt ratio should never cause your cost of capital to change that much. And when it goes up, it explodes out of the box. Notice there's an inflection point where if you get close to that inflection point, things blow up. So the lesson I get from looking at this graph is if you're going to make a mistake on leverage, have too little debt rather than too much. I'd much rather that you be at 10% debt when you should be at 40% debt than if you get to 50 or 60%, because things start blowing up so quickly once you get above that optimal debt ratio that you want to steer away from that in terms of saying, I want to have a buffer between where I am and that optimal. How much of a buffer we can talk about, but that's the basic driver. That spreadsheet you're going to be using, and I'll send you the link to it after the class, has been on my website now forever. And it's been, people download it, they use it. No, they don't have to pay me royalties. I'm perfectly okay with this. But I remember a conversation I had about 20 years ago. The banker who worked at First Chicago, which then got acquired by JP Morgan. And First Chicago, the corporate finance group, had decided to download the spreadsheet, use that for their client presentations. And I knew it was happening, but I get a call. It's a First Chicago banker. It's a landline before smartphones. And I'm sitting in my office, I pick up the phone. He says, I'm calling from a restroom. I said, how the heck did you find a phone in a restroom? And why are you calling? He says, I'm in the middle of a client presentation and something very embarrassing has happened. Call your mother, not me. He said, not that kind of embarrassing. He said, we've used your spreadsheet to come up with an optimal debt ratio, and we put up the graph, and there's a kink in this graph. It's a kinky cost of capital graph, if you're going to describe it that way. Why is there a kink? It takes a lot of gumption to download a spreadsheet for free, use it in a presentation where presumably you're getting paid, and then call me and say, why is there a kink? But I was in a good mood and I told him why. Tell me what it is about the process by which we're estimating cost of capital that can cause a kink in the cost of capital. It's got to, I'll give you a clue. It's got to be something moving discontinuously. What are the only two things that are moving the cost of capital? Cost of equity and the cost of debt, right? Does the cost of equity move continuously? The levered beta will change, even if your debt ratio changes a little bit, because debt to equity rate. What causes my cost of debt to change? My rating has to change, right? The rating changes only if you go to the next level. I said, here's what's happening. I've used this discontinuous ratings process where so what's probably happening is you're borrowing money as you get from 40 to 50%. It doesn't look like your rating is changing, but you're at the very tip and then it takes off. And he said, can I make it go away? I said, yes. And there are two ways you can do it. One is you can take those ratings, they're synthetic ratings, right? I'm not constrained by what Moody's uses. I can make them AA+++, AA++. The finer you make the ratings, the less likely it is you get this discontinuity. He said, that sounds like too much work. I said, I'll give you another suggestion. Why do I use a rating? To get a cost of debt. What if I just directly connected the cost of debt to the interest coverage ratio? In other words, remove the rating entirely. What if I had an equation that says if you put in the interest coverage ratio, and as the interest coverage ratio goes up, He said, that sounds complicated. I said, let me ask you a question. Where is the kink in your cost of capital graph?
He said it's about 70%. So where's your optimal? He said it's at about 30%. I said, then why do you care that there's a kink in the cost of capital at 70%? Just because it makes you uncomfortable. Explain what's going on and move on. So unless you have a kink right at your optimal, which almost never happens, at least you know why it's happening. It's coming from the discontinuity in how we're estimating cost of debt. If it truly bothered you, you can make it go away. But you know what? It doesn't bother me. If it happens, I just let it ride. But it's coming from the process by which we estimate cost of capital. So the cost of capital for Disney at a 40% debt ratio, let's actually look at what the number is 7.16%. Their existing cost of capital based on where they are right now is, I think, I don't know what the number was, 7.7%, 7.6%. But I'm asking Disney to do something monumental, right? Right now, Disney has about 16 billion in debt. And if they believe me, and they might not, I'm telling them their optimal is 55 billion. And not only am I asking them to go out and borrow 39 billion, what am I asking them to do with that debt? Buy back stock or pay a special dividend. It's a big step, right? And assuming that this is the board of directors I'm presenting it to, and they're doing their due diligence, there's a lot of assumptions there. They should have at least 3 questions they should ask me before I walk out of there. If I'm the banker suggesting they go to. First is, why should we do it? I'm going to say, look, your cost of capital will go down. You're going to see very quickly how weak that argument is, because when you look at the cost of capital change, you can say, you want me to do what to get what? You want me to borrow 39 billion to lower my cost of capital by 40 basis points? That doesn't sound like a big payoff. So I first have to make that change in the cost of capital into a real number, a number where they can look and say, that's a lot of money we're leaving on the table. Second question, this is always a good question to ask when you borrow money, is what if something goes wrong? I think, what can go wrong? Never ask that question, because the gods are waiting for you to ask that question, and then something will definitely go wrong. It could be a recession. It could be a theme park getting sued. And the third question, and I think this is a question that I think is worth examining, is what if Disney has other plans to make these big investments, build a new theme park in Shanghai? You have excess debt capacity. It seems silly to borrow the money and buy back stock when you also have these investment needs. So the third question is, what if instead of buying back stock, we took projects instead? Would our optimal debt ratios still hold? 3 generic questions always that need to be addressed whenever you compute the optimal debt ratio for a company that's different from the actual. Let's start with the first question. Why should we do it? No. Right now, the question? Right now, their cost of capital is 7.81%. If they go to their optimal, the cost of capital is 7.16%. So how much will they save? Their cost of capital goes down by 0.65%. And already you can see, if you did this, you're saying, that doesn't sound like much, 0.65%. So I'm going to make this real money. Remember I said the cost of capital is what you use to value a company? I'm going to stay with a very simple valuation model. In a simple valuation model, your cash flows grow at a constant rate forever. I can use that perpetual growth equation. You're saying, how do I know what the growth rate is? I started by estimating what the free cash flow to the firm for Disney as a company was. I know we haven't talked about free cash flows of the firm for companies, but we talked about how to compute the cash flow on a project. We start with after-tax operating income. We add depreciation, we subtract CapEx, we subtract change in working capital. Same process. I do that for the whole company. The number I came up with was $3.657 billion. I know they're existing. Enterprise value, 133.9 billion. Here's what I did. I know the value of the company. I know the cash flow. And I know the cost of capital right now. I can back out from the values. What I'm trying to do is I don't want to get into a valuation challenge here, estimating growth and cash flows, because I want to keep my focus on capital structure. So let the market tell me what the growth rate is. And the growth rate that I end up with is 4.94%. Basically, I'm taking the market value, the cash flows, and the cost of capital and solving for the growth rate. Remember, the cash flows, the growth should stay the same if I change my debt ratio. The cash flows are pre-debt cash flows. The growth is based on those cash flows. So all I did was took the same cash flows, but use the lower cost of capital. And I get this jump in value from 133 to 173 billion. That's almost unbelievable. By going to my optimal, my value increases by almost $40 billion. You know why I'm overstating it? Because that growth rate I'm using forever, 4.94% that I backed out, is not a growth rate you can sustain forever. So this approach of revaluing the entire firm at the new cost of capital is an approach that's clearly going to get you into trouble with high growth companies, companies that are not mature. So I'm going to give you a shortcut that I find useful. This is built into the spreadsheet in calculating value. One way to think about the cost of capital is right now, your entire company is being funded at that cost of capital. So right now, the cost of capital is 7.81%. Your annual cost is basically the market value of the firm, 133.9 billion times 7.81%. So at their existing cost of capital, their financing cost each year is 10,458 million. If they go to the new cost of capital, which is lower, their financing cost each year is going to drop to 9,592 million. So by going to the optimal each year, they're saving 866 million each year. My value as a company should increase by the present value of those savings over time. So you take the $866 million saving and you let the growth rate, remember we talked about the growth rate converging on the risk-free rate, we use that proxy. The value that the company should go up by is about 19.6 billion. So the board of directors says, why should we do it? I'm not going to say 65 basis points because that's going nowhere. Say, if you do this, your value as a company should increase by 19.6 billion. But let's be very clear about where this looks like magic, right? Same company, different financing mix, I increase the value by 19.6 billion. But where is this increased value coming from? I mean, it's the same theme parks, same movies. So where's the $19.6 billion increase coming? I'm sorry? But why is my discount rate lower? It's because I got a tax benefit. Let's be quite clear. The taxpayers are, in a sense, subsidizing this increase. It's not my fault that I'm taking advantage of the tax law. So the next time one of these LBO guys talks about value, increasing value, let's be very clear. LBOs don't increase value. They transfer value from taxpayers to companies. I'm not saying that makes them, that there's something illegal going on, but any increase in value that comes from increasing leverage is not value creation at the economy-wide level, it's a value transfer. Now do you see why if an economy is driven entirely with leverage transactions and you're focused on just the liability side of the balance sheet, you've lost your way? Because companies might get to be worth more because they're getting the tax benefit, but it's coming from some other part of the economy, from taxpayers, and the overall economy cannot benefit if all you're focusing on is leverage and the increase in value that comes from leverage. So again, it's not something that I think should stop companies from borrowing money, but you shouldn't go around boasting about value creation as an LBO guy if the main reason for your value creation comes from the tax code. And the fact that interest is tax deductible is driving up the value even after netting up the potential cost. So when you compute your optimal debt ratio on that spreadsheet that I'm going to send you, it will also compute the change in value in your firm if you go to the optimal. And that's what I'm doing is exactly what you see on this page. I take your enterprise value today and I multiply by the existing cost of capital. I take your enterprise value and multiply by the new cost of capital. And to the extent that the new cost of capital is lower, you're going to save money. Then I compute the present value of those savings. And say, this is how much your value will go up. So if I am to be believed, the value should increase to 153.9 billion. One final point, and then we'll end for the day. Now, the question is, how will this play out in my stock price? Remind me again what I'm going to do with this 39.5 billion. I'm going to buy back shares, right? But how does that work when I want to buy back $39 billion worth of my shares? What do I have to do? to make a tender offer. You can't go, as opposed to what? Companies can go buy back shares in the marketplace, a little here, a little there. But if you're buying back 39.5 billion, you got to let stockholders know the SEC requirement, and you got to make a tender offer. What does a tender offer require? That you offer a price. This is a publicly traded company. The stock price for Disney at the time of this transaction was $67.71. Can you make a tender offer at $67.71? You could, but nobody will tender their shares back, right? So almost by definition, you got to offer a premium. So I'm going to give you what a rational premium would be, and I'll explain what I mean. So you guys planning to sell your shares back, you guys are planning to stay in the company. What is the fairest outcome here? I know the increase in value is 19.6 billion. If this is a fair and rational award, what should happen? Not just as 50-50, but everybody should get about the same increase in value per share. 50-50 might not be fair because there are fewer shares being bought back. They will then get a bigger chunk. But I want to make sure. So here's what I'm going to do. I'm going to take the 19.6 billion, divide by all of the shares outstanding, even though I'm going to buy back those shares. And what that effectively does is it means I buy the shares back at 78.61. They're going to end up with $10.90 more per share. And after they leave, you're going to end up with $10.90 per share. Think of that as a rational conclusion. But remember, you're hiring bankers to do this for you, right? You say, buy shares back. What makes it easier? Setting a higher price or a lower price? They actually want a higher price to get the tender offer done. So if they don't have a reservation price, guess what? They're going to try $85. It's going to make their life easier. They're going to buy the shares back, in which case the people who sold their shares back are going to make almost $17.50 per share. You think, so what? You as the remaining shareholders are now going to get $6 per share if you're lucky, or $5. So we're going to come back and talk about what happens when you buy back at prices that are different from this rational price. But I think it happens all the time. Buybacks often happen at prices they should not be done at because the objective becomes getting the buyback done. So I will see you on Wednesday.
Yeah,
Yes.